Ian Williams, Chief Executive of Charteris, joins us now. He manages the Charteris Premium Growth Fund. Ian, thanks for joining us. Equity markets stopped in their tracks in the last day or two. What's going on out there? Did it become too far, too fast?
Well, it's come up a long way. We still think it goes quite a bit further, actually. We're quite positive. In a perverse sort of way, listening to Mervyn King yesterday being cautious, we think is actually good, because what it means is that quantitative easing carries on for longer, and we think quantitative easing is the big driving force that's turning.
And that means they've got to extend the QE program, because they extended it by 50 billion last week. What else do they have to do?
Well, that's pretty powerful on its own. I mean, the worst thing they could do is to get too optimistic too early, call a halt to the quantitative easing, and then find it slips back. But the fact that the central bankers are cautious, we actually read is quite positive for the market.
Thing is, Ian, gilts have remained stubbornly high, haven't they, since the start of this asset buying program? Yeah. So is that an issue? Is that a problem?
No, not really. I mean, I also run a gilt fund as
well.
Of course. And with that fund, we switched most of the gilts into index-linked gilts for reasons, again, associated with quantitative easing. I mean, quantitative easing is an incredibly powerful tool. There's also, with it going back to the equity markets, uninvested cash relative to the market cap is at very extreme levels. It still is. There's still a lot of cash around in the market. Companies have cut costs, and the long-term valuation levels, gilts against equities, are at 25, 30-year extreme cheap levels relative to conventional fixed interest. So if anyone is prepared to take a slightly longer-term view, equities is still unbelievably good.
How long are we looking at? What sort of view should we be taking?
Well, you know, traditionally, when we sign up private clients, we always say, look, you should really take a 2-year view on this. I mean, you can buy top-quality companies like Vodafone now on 6% yields. I mean, you know, it's only because you've had a recession that those sort of opportunities are available.
For companies today like BT, their dividends come down from a year earlier, hasn't it? So
we haven't got that one.
Yeah, you haven't got that one.
We sold that one.
Anyway, so you're quite
you've got to be select.
Yeah.
I mean, you know, we've got telephone exposure through Vodafone, because we think that, as I say, on a 6% yield, it's come down from £2 to £1 a share, roughly, and it's a 6% yield. I mean, you know, if you're prepared to take anything other than a very short-term view, that sort of thing.
A couple of other tips for us. Do you like Vodafone? Any others out there that stand out, really stand out?
We still think there's a lot of potential in the mining stocks. People think like Xstrata and Vedanta. I mean, Xstrata's come down from like £25 to £3. It's up to 6. We still think it could easily go up to 10, 11, 12 pounds before, which is still only a 50% retracement on what it took off in the bear market. Because it's not just the UK that's quantitative easing. Chinese, everybody's doing quantitative easing. It feeds straight through the commodity markets, and you know. So
keep an eye on those miners. Thanks, Ian there from Charteris.